Welcome back, everybody, and welcome back to Buyer's Blueprint. And in this video today, I want to talk about, you guessed it, gap insurance. What is gap? Well, it's guaranteed asset protection, and it is a product that is going to be offered to you in the business office. And a lot of people say, oh, it's total waste of money, you don't need it. And that might be true for a percentage of buyers, but it is definitely something that you should absolutely consider depending on what kind of buyer you are, what your credit looks like, how much money you've put down, or maybe what kind of trade equity you had as a down payment on your loan. Oh yeah, it's associated with loans. You can't necessarily get gap if you paid cash for the car because there's no negative equity because you don't have a loan. So where gap insurance comes in is when you have a payout on your completely written off car from your insurance provider and it falls short of what is owed on your loan. So you could buy a $40,000 car, total it in, let's say, 4 years, have an 84-month, 96-month loan on the car, still owe 30 grand, but your insurance provider is only going to pay you 20 because that's sort of the going rate. You can negotiate that a little bit, but let's just say after negotiation they give you 20 grand, but you still owe 30. You still owe the bank $10,000. And so what a lot of people end up doing is, and this is when it comes more and more and more important to get gap, is they'll take that $10,000 negative equity, if they're able to, if they've got the credit for it, and they'll tack it on to the new car loan that they're getting for their new replacement ride. So they're buying a new $40,000 car, but they're not going to borrow 40. They're going to borrow $40,000 plus tax and $10,000. So now, once again, to get their payments down, they're going to borrow the money for even longer, to get the payments down, and they're going to stay in a negative situation on their loan as the car depreciates, and they're making really small payments on it. They're going to have this negative equity there for years, and you stand to fall victim to this again. So there's varying types of gap for both new and used cars. So you can have it on new, and you can have it on used. So in general, on new cars, you can get it on a term of a loan up to 84 months, and on used, you can get up to a term of 60 months. Now on a new car, the car can be 1 year or greater, whatever that is, whichever the right way to do it is it's either 1 year old or newer. And then on used, the car has to be 5 years old or newer. There we go. That's what I'll do. I'll do this. I'll go 1 year and newer, and 5 years and newer on the used. 60 months and 84 months. So now in very general terms, these policies on a longer term loan, which is when you need it, should only cost you around $20 a month. I think that's absolute gold if it fits for you. So for example, you're buying a car, let's just say it's 50 grand, whatever. You're gonna pay a bit of tax, right? You're gonna maybe buy a warranty, right? Let's say you're one of, I think 39% of buyers have a bit of negative equity in their trade value, in their car that they're trading in. And so I don't know exactly what that number is, but let's just call it 5, 6, 7 grand, right? So there's another bit of numbers there. So now this is how much your loan is for, right? But here's the car. This is only the car here. So let's say you get an 84-month loan and you get down the road 4 years, and in 4 years on average cars depreciate around 50%-ish. So let's just say you get there 4 years. This here is what your insurance provider will give you when you write your car off, right? But on an 84-month loan, in 4 years, you're barely going to be halfway through. This is how much you're going to have negative equity. So for $20 a month, I say I'll take it. But there's varying kinds of gap, which I'll get into right now. So for new cars, you can have replacement, and you can get that for used cars as well, replacement. You can have, what is also important for people is they're all slightly different products. They don't all cover everything, but replacement is one. Down payment protection is another. Total loss, that's another one. Partial loss, that's another one. There's another one that is trade value protection. So trade value protection, right? So there's lots of different versions. So you have to be very sure and make sure that you understand what it is that the business office is pitching you, because they all have different implications. Oh, also, certain gap policies, the maximum payout is $100,000, and that'll still be included in, let's say, $20 a month, $25 a month. But there's other cheaper versions, what they might tell you is $20 a month, but they're grossing you one, that have a max per value. So, for example, on down payment protection over here, let's say you put down 20 grand, right? Because you needed to. Let's say your credit was such that you needed to put 20 grand down in order to get approved. Now, a few years goes by, you total the car, the insurance company pays out basically what you owe, and you're kind of at scratch, at zero. You go in a dealership, hey, I need a new car, and they say, hey, that's great, we need another 20 grand. And you say, well, where am I gonna get that? So where you get that is from Gap. And but if you put 20 grand down, make sure that the policy you get will cover 20 grand, because some have, let's say a 5K or a 10K max. And so you want to make sure that you are getting covered for the amount you'll be out. In general, these amounts pay out much larger if you total the car, write the car off further into the loan. So in other words, if you have a 96-month loan, get Gap, because the difference between a 2-year loan and a 96-month is that you're going to pay off that car in 2 years. You're going to get well ahead of your depreciation curve almost right away. But on a 96-month, you're going to be owing more to the bank than the car is worth for the majority of the loan. So at any time for the majority of the loan, except let's say in the last year and a half, 2 years tops, you will be backwards. In other words, if it gets written off, insurance will pay you out for what the car's worth. That's great. The bank that money goes straight to the bank. It doesn't come through you. You can't use it for anything. It goes straight to the bank. But what the bank will say is, hey, that's really great, Mr. Customer, but you still owe us 2 grand, 1 grand, 5 grand, 10 grand, 20 grand, 30 grand, right? Based on how much negative equity you had from your previous car on this loan, depending on what the tax bracket was. Oh no, that wasn't tax, that was warranties. Depending on what the tax bracket was in your cars, in certain states and provinces, there's luxury taxes, more tax, whatever. And of course, depending on how much your car was valued at to begin with, right? So, and policies for Gap, they cost less money for less expensive vehicles. There's usually bridges. So under 20,000 is a certain amount, up to 50,000, 20 to 50,000 is another amount, and then above 50,000 is another amount. Usually Gap insurance doesn't cover cars more than about 150 or 100 to 150, and there are some exclusions. Aston Martin, Bentley, Ferrari, those kind of vehicles they don't want to get into. But that's that. Let's see, what else do I need to cover here? You can finance this that's why I said it's $20 a month. You can finance this in your lease or loan, and the other thing is depending on what kind of a dealership you're at and what state or province you're in, the business office might not be able to offer you this insurance product, in which case you'll only be able to get it offered to you through the insurance agent, which is generally after you get approved and sign all the paperwork for your loan. So what you might want to do is discuss that with the business office first. Why? Because then you can coordinate with the insurance agent, get offered the right Gap product, and then put it into the loan before you sign off on the loan, and then realize, oh, Gap insurance, I should get that. And then they want their $1,500, $2,000, $2,500, depending on how expensive your car is and all that good stuff, and what the limitations are on the Gap product that they're offering you. And so that's one consideration. And should I cover anything else here today? No, I don't think so. But if you feel I've missed something, if you have a question that I didn't cover here, feel free to ask it in the comments below, like and subscribe and all those good things. And I'll see you on the next one. Thanks again.